This time of year, as the election season approaches, one of the top questions that we get from clients is, should I change my investment strategy? What do the markets tend to do when elections arise? Maybe even more commonly, is if so-and-so wins, it's all going downhill, right? So I should probably change to cash, move my investments, change my strategy, wait it out, see what happens. And so this is a question that we talk about very regularly. And but we never just want to leave it at it'll all be okay. We want to bring the data and the evidence to back up that claim. And so what we're going to do today is an exploration of that question. And I couldn't think of anybody better than you, Russ, to walk through this. So Russell Martin is a senior portfolio manager, years and years of market analyst experience, and has taken some deep dive with his team into this question of how presidential elections and the market relate to one another. So wanted to bring you on to ask for some of your insight and what you have to say about this, Russ. So thanks for joining this morning.
Yeah, thanks so much for having me. Glad to be here.
Maybe before we dive in, you can kind of give us the your baseball card stats of who you are and why you're in this business.
Sure. So senior portfolio manager at City National Rochdale, as you mentioned, I've been here 11 years. I've been working with the team at Altera Advisors since 2014. Prior to that, I did about a decade with Charles Schwab in a number of different roles. Have been in the investment management business through all different types of market cycles, the 0809 financial crisis, COVID, multiple Fed rate hike and cut cycles, all sorts of geopolitical and domestic events. And we've got a lot of research to back up the guidance that we want to give clients during periods like this where there's a lot of uncertainty.
Mm-hmm. Yeah, that's great. And I mean, one of the things that we'll both have talked with clients about regularly is the fact that market volatility is the norm. It's not the exception. For anybody, you guys have done great research on just market volatility in general. For anybody who's watching this and wants to take a deeper dive into that, we have an article that will be linked in the description that talks about a history of market declines. And even in up years, people forget that in 2020, which was the COVID year, uh, all people think about was the world falling apart. Which was, I mean, we went through some craziness. But if all the evidence that you had from that year was the starting value and the ending value of the stock market, you would think this was a boring, slightly kind of up year in the stock market. So volatility is the norm; it's not the exception. And people investing in stocks, for a reasonable amount of time, kind of know that. But what I'm hoping we can do is dive into that question about how volatility and elections tend to relate. So do you mind kind of sharing your perspective on how markets and elections tend to react to one another?
Yeah, well, you said it very well that even in years when markets are positive, it's very common to have pullbacks or corrections during
Yeah.
the year, sometimes 10, 15% or more. And also, even in years where you have sizable downside moves that feel like, gosh, I've got to do something about this and get out of the market, oftentimes you will see that the market recovers by year end and delivers that positive return. So we can kind of look at it both ways. And
Hmm.
it just highlights that we want to be really careful about our emotional and visceral responses to seeing those correction or volatility type of moments in markets. Because often, if we take that bait, we end up hurting ourselves by making a decision that isn't in our best long-term interest. And we've got some data that we can share with the audience here on what happens during various years of the election cycle. The key takeaway is that in all 4 years of election cycles,
Let me
we've
bring
kind of
that up for
anchored
us here real
this.
quick.
Yeah, sure. We've
Yeah,
anchored
great.
this analysis around the 4 year presidential cycle.
Yeah.
But you can see on the top of the page here, these bars are all positive. So we looked at averages and medians, and what you can see is that on the left-hand side there, on the top chart, election years are generally pretty good return years, and we've got a little more detail we'll go into on that in just a
Yeah.
moment.
Let me do a quick breakdown of actually what we're looking at here. So this is research that you and your team have put together, which is your research is always top notch. We always learn a lot from what you guys put together. At the top here, so you guys kind of have some statements at the top of each of these, which we always like because it helps us to see, okay, here's the conclusion you've drawn. Now let's see if that proves to be true. At the top here is since 1928, how is the S&P 500, which a lot of people take as kind of a measure of the US stock market, How has it performed on average each year of the 4 year election cycle? So you've got the election year, you've got year one, year two when they do the midterms, and then year three, and then we rinse and we repeat. So maybe let's, you guys even, of course, because anybody who's going deep in the weeds would do this. You look at not just average, but median. So just for the sake of our conversation, let's focus in on the averages here. So what do we learn when we look at the top chart here?
Yeah, so you'll see all 4 years of the election cycle result in positive average returns for the
Hmm.
market. And election years actually tend to be one of the better ones in the overall cycle. Now you can see clearly the third year on the cycle historically has delivered on average the best returns. But election years are coming in a good second place, if you will, there. And so just goes to show that just because a presidential election is occurring doesn't mean there's reason to panic or to think that there's going to be some type of major market decline.
And then what I love about this is the next question that follows is, yeah, but this year's going to be different because what if so and so wins? Uh, and that's the person I like or the person I don't like. Who and whatever your political persuasion is, we hear the same thing on both sides, and so they're fair concerns. People have a lot of justifiable concerns based on their perspectives on different issues and so on. What we want to do is go, okay, we want to bring the numbers and the research when you talked about the emotions earlier, Russ, we always think about those as not they shouldn't be ignored, but they should be an indicator to research something further. If I'm feeling strongly about something, let me first see if the conclusion I think my emotion would lead me to is the right one based on the evidence. So one of the next ones that people will ask is, well, what if so and so wins? And you break all that down here. So this looks at not only so up here is kind of more average throughout the market based on election cycles, but down here you guys even go as deep as what about years when the presidency, the Senate, and the House were all controlled by fill in the blank party, Democrat, 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 all three areas. Democratic president, Republican Congress, Democratic president, and so on, right? Uh, and again, the story plays out the same. So, what might you advise somebody based on kind of what we see here?
Yeah, so I think, we don't want to be driving down the highway looking in the rear view mirror. And so the historical data here, what it clearly shows is that regardless of the composition of control of the presidency and Congress, on average, markets have delivered positive returns. And so it kind of reiterates the focus on how we want to be making investment decisions, which we know is centered around the client's financial plan and is
Hmm.
really geared around those fundamentals that are driving the economy forward. So, is there money flowing? Are companies making profits? This here just shows that there's no distinct or discernible major difference between who is controlling the various components of government and how the financial markets perform. Now, of course, there is the one outlier on the far bottom right side of the page here, a 2 year sample of when there was a Republican president, a Democrat Senate, and a Republican House. That included the dot-com bubble and the 9/11 attacks. So that was 2000 to 2002. And, a little bit of exogenous events there skewing that data. But
Sure.
clearly, this shows that making investment decisions based purely upon which party is winning in various components of government, probably not the best strategy to pursue.
Well, and even the let's see, I'll go to the next block that you sent over because this is then a layer deeper. People will often go, well, what about okay, averages, easy to hide, lots of volatility in averages. So you broke it down even further. So let me kind of do the quick flyover of what we're looking at, and then you can make any comments that jump out at you. So on the left here, again, we're going to use the S&P 500 as kind of this benchmark just to keep things simple. Uh, on average, between 1928 and 2023, the S&P 500 performed at an average of 7.5% during the presidential election year on average. But on the right side, people can go, yeah, but were there some that were just super, far down and then some that were uh, what kind of a ride am I in for? Don't hide behind the averages here. And you go, okay, well, let's do that over here. So you've had 23 of these years. In the dark blue, 18 of those years were up, and then five of them were down. And so again, good reason to think from an election year standpoint. Again, what's the premise we're trying to test here? It's how do markets and elections respond to one another? And it seems that, again, as you said before, election years are the second highest on average performance year. Again, that's not, again, you shouldn't make a decision in the pro side that way either, right? You shouldn't skew your investments towards stocks in election years. But then even that on balance, the number of positive years are even far in excess of the negative years.
Yeah, that's exactly right. It's just further evidence to not be having any panic or making any major changes to your overall financial strategy,
Yeah,
even though you may be feeling very strongly about a potential outcome or a potential policy change or concerns you might have or confidence that you might have.
yeah.
Any type of these short-term kind of news cycle type of events, we want to be really careful about making any major financial changes around those, but rather remain focused on the things that are truly most important, which is your specific financial plan and
Hmm.
what are the underlying fundamentals in the economy and the financial markets that can drive the selection of the best investments there and managing your risk appropriately for the returns that you
Yep.
need to get for your plan.
Yep, that's great. You also make the point that sometimes volatility around election days can happen. So you gave some analysis here. We'll pause on this very briefly, because again, it's pretty clear from the evidence that folks should not be changing their strategies dramatically based on the fact that just that we're in an election year. But what I find that, okay, if I accept that, if that's how I as an investor am going to behave, it helps me to know just historically how has the market behaved around this. Even if I can't predict it, if I can just expect something's going to be a little more volatile, at least it helps me know. I don't want to be surprised by it. Let's maybe say it that way. So 30 days before the election and 30 days after the election, how has the market responded? And you break it down in the, the CNR fashion in a very granular but helpful form from my perspective. Anyway, so I'll just help people understand how you could interpret this, and then you can pause here and you can really digest the information if you'd like to. So this tells me, I'm just going to circle this one here, in 6 years, 6 election years, 30 days before the election, the market was up 1 to 2%. In 3 of those years, it was down 2 to 1, between down 2 and down 1%. And then post-election, I have, 2 years where the market was down between 8 and 6%, between 8 and 6%, but then 7 years where it was up between 4 and 6%. So correct me if I'm wrong. It seems like volatility can pick up around election days, but not clearly as though it's going to go down, it's going to go up. Just the market doesn't like surprises. Is that kind of what we're taking from this?
Yeah, anytime there's uncertainty, you generally tend to see some heightened volatility in the market. I sometimes joke we could probably title this slide "Volatility Around Any Day is Possible," but we have centered this
That's yeah,
analysis
yeah.
around the elections. And what you see here is that yes, markets will exhibit some movements anytime there is potential changes to the rules of the game, so to speak. You'll see some volatility there. But what's really interesting is that you do see that a good number of these years actually show that the volatility is to the positive side.
Sure. Yeah.
And so that kind of speaks to just general market behavior, where we know that volatility is a part of being an investor, particularly in stocks, as we're showing here, but that over time, stocks have been one of the greatest wealth creators in the American economy and the global economy. And
Hmm.
so I think that's kind of the key takeaway is to have that expectation, as you said, of some movement, but to know that it's not necessarily reason to panic or that there
Sure.
needs to be any action taken around that.
Well, and the last chart that I wanted to bring up is talking about market timing. And so okay, what is market timing? It's the idea that maybe I'll try to move my money out of the market before something bad happens and then back in after it happens so I can benefit from the swings. Uh, the problem is nobody has the crystal ball. So this is not going to be a surprise to anybody listening to this, probably. Uh, but it can feel as though waiting on the sideline is a no risk position, and being invested is a risk position. But if the goal is to grow your wealth over time, being out of the market on some of the best days, just a few of the best days, makes a massive impact. So, Russ, I'm going to break down what you have here and just contrast two columns, and then you can add any final comments before we wrap this thing up here. Okay, so between 1990 and 2017, if you were fully invested, so down here you see stayed invested, no missed days, you had your money in from start to finish between 1990 and 2017, you averaged a little over 10% per year. A little over 7,000 days being invested. Okay, so that's a while. If you missed just the best 50 days, so you tried to guess and be right, and were just happen to get it wrong, it didn't just hurt you a little bit. That's not even 1% of the days. That's less than 1% of the days. And your average return went from 10 to 1. If you added 20 days that you missed, you actually lost money over that time period. So 70 days out of 7,000 really were the ones that led you to your big return here. If you missed those, your average results were dramatically affected. So being out of the market and trying to guess what's going to happen and when is not a no risk decision. That's a pretty risky decision, is kind of what I'm taking away here.
Yeah, I think that's exactly right. Nobody in the history of the world, whether it's a human or any technology program, has been able to predict short-term market movements on a daily basis. So we don't know when these best days of the market are necessarily going to occur. And we have to have some humility as professional investors and as individual investors to recognize that that is a part of creating a successful outcome.
Yeah.
So when we feel those strong emotions and a desire to act, we need to be really thoughtful about that. And as you said, the idea of going to cash and waiting on the sideline, the way I like to say it is that sometimes we're trading. What we gain is short-term emotional security. We might feel better for that, but
Mm-hmm.
the trade-off is our longer-term financial security and the choices that we want to have, the
Mm-hmm.
vision that we have about what our future is going to look like. And
Yeah.
so being able to manage those, and importantly, Josh, I think having a great team like you and the team there at Altera Advisors, that's why we love working with people like you, and why I'm sure
Mm-hmm.
your clients do, is being able to help guide through those periods where maybe we're having that impulse,
Sure.
and we need to keep a steady hand and stay focused on our financial plan and what our goals and objectives are.
That's awesome, Russ. Well, thank you so much for joining this morning. Really appreciate it. Want to do a little bit of legal business clarification here. Altera Advisors and City National Rockdale. So our company here at Altera, the City National Rockdale company, Russ, that you're affiliated with, we're separate and non-affiliated legal entities. City National Rockdale LLC is an SEC registered investment advisor, a wholly owned subsidiary of City National Bank. Registration as an investment advisor does not imply any level of skill or expertise. City National Rockdale is a subsidiary of the Royal Bank of Canada. For us to be able to have the freedom and flexibility to have conversations like this, those are some of the cover the bases clarifications we need to put out there. So Russ, thank you so much for your time and your expertise on this. We really appreciate your insight. And if you're watching this, hopefully this has been valuable to you. If you're looking for an approach like this in your planning and a bank of resources bringing to the table, like folks here, like Russ, feel free to reach out to us here at Altera. So Russ, thanks again as always, and looking forward to chatting again.
Thank you, Josh.